Imagine waking up and realizing one of the most undervalued assets on the planet has quietly surged past the point experts once called impossible. Imagine discovering that hundreds of millions of ounces have vanished from global inventories, yet the world kept moving as if nothing happened. And imagine learning that while most people were distracted, a crisis years in the making was accelerating right beneath their feet. That's the moment we're living in right now. Silver, long overlooked, long ignored, long dismissed, has crossed levels some analysts are calling the highest in modern trading history, above $64 per ounce. And according to many who study long-term commodity cycles, this may only be the beginning. For decades, silver has been the metal that slept. Quiet, steady, unexciting. But beneath the surface, something has been building: pressure, scarcity, structural imbalance, a pattern older than modern finance, older than Wall Street, older than central banks, a pattern that has repeated itself throughout civilizations every time currency is debased, every time industrial demand outruns supply, every time inventories fall to critical levels. And the pattern is simple. Markets don't ease into equilibrium, they explode into it. Some analysts already expect silver pushing past 65 and climbing. In early 1979, silver traded around $6. Two wealthy Texas oilmen, the Hunt brothers, saw something almost everyone else ignored. Global silver production was flat. Industrial consumption, photography, electronics, medical applications was climbing. They began buying physical metal, futures, massive quantities. The market woke up and prices jumped to $15, then $20, then $30. By January 1980, silver briefly touched $50 per ounce. A nearly tenfold move in under 12 months. Was there speculation? Yes, but the underlying shortage was real. Industrial buyers panicked, hoarding began, supply tightened, prices soared, a feedback loop born from scarcity. Regulators eventually stepped in, changed the rules mid-game, and forced positions to unwind. Prices collapsed. But the math behind the shortage remained valid. Fast forward to the late 1990s. The digital era exploded. Computers, mobile phones, digital cameras. Electronics demand for silver surged more than 40% in a few years. But mining output barely budged because silver is mostly a byproduct of copper, lead, and zinc mining. If those metals aren't profitable, silver production doesn't rise either. Inventories began collapsing. 350 million ounces, falling to 200 million in 3 years. Prices climbed slowly from $4 to $7. Then 2008 hit. The financial system trembled, investors rushed to hard assets, and silver spiked toward $21. Then came 2020, COVID lockdowns, shutdowns, supply chain paralysis. Global silver production dropped. But something more important began unfolding. Solar panels, EVs, 5G networks, AI infrastructure, industries expanding at staggering speeds, all requiring silver. Solar alone now accounts for more than 20% of total demand. And solar deployments are doubling roughly every 3 years. Analysts widely believe the world has entered a structural deficit every year from 2021 to 2025, showing significant shortfalls. Some reports estimate 2024's deficit near 280 million ounces, one of the largest ever recorded. This is happening while China reportedly prepares to restrict silver exports beginning in 2026. India's imports are hitting new highs, and major vaults like COMEX and LBMA show inventories steadily declining. Prices have climbed from $18 just a few years ago to over $60 today, more than a 250% rise in around half a decade. And before we go any deeper into what analysts think may come next, take 2 seconds and make sure you subscribe to Billionaire Playbook right now. If you want to understand the cycles the wealthy watch, the moves institutions prepare for, and the patterns repeated across decades of market history, this is the place for you. Don't miss the next major shifts happening right now, because where we stand today may be the most important phase of the cycle, the explosion stage. Inventories are thinning rapidly. COMEX warehouse stocks reportedly below 300 million ounces. London vaults showing similar declines. Indian premiums $7 above spot. Silver lease rates spiking, suggesting physical scarcity. ETF inflows accelerating. iShares Silver Trust recently added over 500 tons in a matter of days. The Federal Reserve cutting rates, weakening the dollar, pushing real yields lower, all historically bullish factors for precious metals. But this time, the difference is enormous. In 1980, silver demand was driven heavily by photography. In 2011, speculation played a massive role. Today, demand isn't speculative, it's industrial. Solar, EVs, 5G, AI data centers, medical devices, all expanding at rates that appear nearly unstoppable. These industries do not care about investor psychology. They do not sell because sentiment dips. They do not wait for pullbacks. They buy because they must. They cannot function without silver. And in many applications, there is no practical substitute. Recycling? It contributes around 200 million ounces per year, but the problem is simple. Silver is dispersed in tiny amounts across millions of devices, solar panels, medical tools, and electronics. Recovering it is expensive. Most products aren't recycled for decades. Solar panels installed in 2010 are only now starting to reach end of life. And even then, recycling infrastructure is limited. By the time meaningful recycling scales, the deficit may have swallowed billions of ounces. Technology replacing silver? For decades, people have said this about copper, lithium, rare earths, and it rarely works at scale. Why? Because silver has the highest electrical conductivity of any metal, the highest thermal conductivity, antibacterial properties, high reflectivity. These aren't qualities that can simply be replaced with a cheaper alloy. Reducing silver usage in solar may slow demand growth, maybe, but it won't reverse it, especially as EVs, AI hardware, and medical devices accelerate simultaneously. Some analysts expect silver prices between $65 and $70 in early 2026. Others see $70 to $80 by mid-2026, including Leopard's $75 projection. If deficits continue, inventories could fall below 200 million ounces globally, potentially less than 2 months of supply. Historically, when inventories hit those levels, markets break. Prices gap upward. 10% moves in a single day, 20% moves within a week. And if mainstream media begins amplifying the story and retail investors rush in, the velocity could multiply. By late 2026, several institutions have entertained targets of $80 to $100. Some technical analysts, like Michael Oliver, have even suggested possibilities far beyond that if momentum accelerates. $100 represents barely a 50% increase from current levels. Gold rose nearly that much in the last 2 years, and gold does not face the same supply constraints silver does. Could silver hit 150, 200? It's impossible to say with certainty, but historically, when commodities break from structural deficits, they do not move in linear fashion. They leap. Investors typically explore 3 categories of exposure: physical metal, coins and bars stored privately without counterparty risk; ETFs, liquid, convenient, simple, but still within the financial system; and mining companies, the leveraged play, where a 10% move in silver can produce much larger moves in minor equities. But miners carry operational risks, labor strikes, geopolitical tensions, cost overruns. They offer upside with volatility, or people do nothing. Assume the pattern breaks this time, assume supply magically rises, assume substitution appears overnight. But if those assumptions prove wrong, the move could unfold without them. Pullbacks will happen. Corrections will shake out weak hands. Silver could drop 5 or 10% in a day. But cycles aren't defined by daily noise. They're defined by structural math that doesn't care about emotions or opinions. If the deficit continues, if inventories fall, if industrial demand accelerates, the long-term trajectory may remain upward despite volatility. Silver's current setup, according to many analysts, is one of the most asymmetric opportunities in global commodities. Downside, limited to the mid-50s. Upside possibly reaching 100 or more. A potential 5 to 1 or even 10 to 1 risk-reward ratio. Throughout history, from ancient Rome to Weimar Germany, from the Hunt era to the dot-com period, silver has surged when currencies are debased, when demand spikes, when supply tightens. This cycle appears no different. Human nature hasn't changed. Governments still print money when pressured. Industries still consume resources relentlessly. Scarcity still forces markets higher. Silver hitting $75 by mid-2026 isn't a prophecy. It's the continuation of a pattern that is played out repeatedly, a pattern that analysts, institutions, and historians are watching closely, a pattern that may be unfolding right now at this very moment.